Now, from the Enterprise Estonia side, I would like to welcome all the panelists who are here already. We are very pleased to have joined up with Andrew and Rich, Peter, and Tim will come in very soon as well. And yes, the idea today will be to talk about the access to capital in the new conditions that we all find ourselves in. I thought I'll very briefly, as an introductory note, say a few words. I have been working for Enterprise Estonia as the representative for Estonian Trader years, and during that period, I have certainly seen how London in particular has become this mega super city that everybody wants to be part of, and we have had a great number of our success stories with the unicorns growing, and we've got the highest number of unicorn per capita in the world still, and London has played a vital part because they're all had form of financing or activities based in London. Now, in these new circumstances, we would like to discuss how things will develop and the role of the UK for Estonian companies as well. Therefore, I am very pleased to welcome Andrew to kick off our webinar. And yes, Andrew, over to you. I have a note here that you have arranged more than 3,000 roundtables in London so far. So you should be very much aware of what's happening and what are we expecting.
Okay, can I take over now?
Yes, you can, of course.
Okay, great. Well, look, thanks to Trade Estonia, Enterprise Estonia, the Estonian Embassy, whoever it is in Estonia that we've been involved with on this. I'm Andrew Hilton. I'm from the Center for the Study of Financial Innovation. That's my day job. We're currently in virtual mode, and I'm delighted to be helping the Enterprise Estonia look at capital markets in the UK when it comes to technology. We have three very eminent panelists. Tim Levene, the CEO and partner and co-founder of Augmentum FinTech. He is not yet online, but I am assured that he's on his way. Richard Abrams, senior manager at PwC, and a founding team member of PwC's RISE group, which is helping scale up Series A equity in the FinTech area. He's also a co-founder of his own little technology company, Marifarm UK. And finally, Peter Ferry, founder director of Wallet Services in Scotland, and a strong proponent of what he says, simplifying blockchain for business and government. Anybody who can simplify blockchain deserves a medal. He has been rooting for Scotland in the blockchain revolution. I think when they've got nothing to do in the winter and it's permanently grey and damp, they can really worry about blockchain and football, nothing else. So we have three very eminent panelists, but as I say, unfortunately, Tim is still not online. However, I think it would be right to ask both Richard and Peter to talk a little bit about what they see as the issues in accessing capital in the UK at the present time when it comes to the COVID, how that has affected capital raising here, how should we redesign perhaps products to make them more attractive to the market as it exists at the present time, and what really is affecting international investment decisions. Can I ask, first of all, Richard Abrams from PwC to talk a little bit about, you recently produced a survey, you co-produced a survey on venture capital in the tech area and what it's, how the present problems have impacted it. Talk a little bit about that and how you see the capital raising ecosystem here in London.
Yeah, definitely. Thanks, Andrew. And great to be here with everyone. As you mentioned, there's been some interesting activity over the past few months. We did produce, and we spoke to 84 different investors to understand their view on things in a not post-COVID world, but almost a during COVID world, and the impact of that. And to go back to, let's say, March time, what we were definitely seeing in terms of the investment process was that a lot of investors, and hopefully Tim will be able to confirm this when he joins, put the brakes on any new investment activity, looking at their portfolio companies and seeing what needed to be shored up, and making sure that those that they already had investment into were going to be okay to ride out the current situation with a lot of bridge funding. What we saw immediately was the view that those, as Andrew mentioned, in terms of those that supported things like remote working, EdTech platforms, both B2C for kids who are out of school, and B2B for kind of the software supporting that, as well as underlying platforms across industries, were going to fare well, while things that relied on physical activity, so your leisure industries, weren't going to be so hot moving forward. With regards to the FinTech industry, and specifically, the thoughts were that this would be largely okay. It is the hot sector, particularly in the UK, and we've seen a number of unicorns and really high growth companies come out of that space. But at that point, there was a bit of uncertainty around most sectors, to be perfectly honest. I think over the last 2 months, since things like in the UK in particular, we've seen things like the government furlough scheme, a number of loan schemes to support businesses through the current uncertainty, which is very different to what we saw 10, 12 years ago in the last recession. A lot of businesses are fared better than expected, and the ability to work from home, as particularly software businesses, which a lot of fintechs are, has allowed us to kind of ride a wave in a way. And so over the last few weeks, we've seen that a lot of investors are coming out and saying we are open for business, looking at all sectors, particularly fintech definitely being one of them. Particularly those fintech, I think the majority of fintechs are actually platforms that underpin the industry rather than consumer facing, as an example. So a lot of them are still doing well, but what we're seeing is a bit of a hit on some valuations.
I'm delighted that we almost saw Tim Levene there, and I hope that he will come on. But can I just pick up, Richard, on one thing you said? Some sectors have fared better than expected under the terms of the lockdown. Tell us give us some examples where you feel that people have fared better than we expected.
So for example, I'm not specifically related to the lockdown, but I'm a board advisor to a fintech called Chip, who support individuals saving money. So it's an automated saving app. So in a time where people are worried about their jobs or their savings, they've seen an uptick in the number of downloads and the number of active users. I've also seen with a couple of my clients in the EdTech space, one in particular who supports kids with their reading and writing through a software platform. Obviously, with mums and dads homeschooling, they've seen a huge uptick in the number of subscribers to their platform compared to when kids are going into school. So all around remote learning and supporting the current process.
Okay, well, Tim, I introduced you before you came on. I'll give you a chance to respond to that. But first of all, Peter Ferry, how do you respond to it? And particularly, I guess, your specialty has been very much blockchain, but you're also involved, I notice, as the honorary consul of Estonia in Edinburgh, and that you have yourself business interests throughout Estonia. So you're very much clued into the Estonian fintech area and indeed into technology more generally. Peter, your views. So
if I can just kind of first of all introduce myself and my position. So yes, I'm an honorary consul for Estonia in Scotland. Ma olen au consul Šotimaal and it's very nice to be here and to address colleagues in Estonia. So, as you mentioned, we work in the blockchain space, and we're all about connecting organizations with trustworthy data. And pre-COVID, our customers have included governments such as Scottish governments, and the customers in the oil industry such as Chevron Oil and Baker Hughes. So I have a kind of micro view of that macrocosm, because as a 3-year-old company, we'd just started a seed round of investment in January, just before the crisis and the lockdown manifested itself in the UK. So I've been in a position to develop some few views firsthand as we've raised funding and seen how the company have had to react, and how investors and potential investors have reacted. We're likely to close our seed round within the next month, so we've kind of been through the crisis and learned from it. And I would observe that in some cases now, although there was certainly a period where for a lot of startups who were looking for seed investment, they saw a lot of their business go right and delays to revenue. It does certainly now seem to be a position where it's accelerated some of the adoption of technology that we're working in, and it's kind of shown the benefit of the move from paper to online processes, which helps us sell our solution. And I think my other observation would be that it's put in the UK, as many companies have had to react to this new world, it's put a lot of larger companies in a similar position to startup companies, where they've suddenly found themselves in a position where they have a limited runway and have to decide how to pivot and react to changing circumstances. So I think within that, in terms of how to react, I think rule number one for any business has to be to not go out of business. And my organization, like many other startups and otherwise, had to act fast and decisively to cut costs and reevaluate some of the markets as we were looking in investment, to look at their outlook in terms of sectors to see where future growth is going to come from. I came by an excellent report, several excellent reports, but one particular from Ernst & Young around the COVID-19 outlook by sector, which reflected a lot of the views that we were hearing from potential investors about our target sectors as we looked to take on a seed investment. So I think in reacting to the crisis, it's made us think about how customers need to save money rather than making money, and how our products and solutions address that. We've had to look at the benefits of our product in the light of COVID-19, and actually found some particular opportunities in that. And as we've engaged investors, we've had to show we have a business plan that's changed in reaction to the changing market. We've certainly seen that an investment we expected to be complete within 3 months has taken longer, around 6 months. Initially, we did see evidence that investors were looking at their existing portfolio companies, but it does seem now, a few months on, that the impact on valuations and the money available to adding new companies to investors' portfolios, that does seem to have moved forward. I think that being based in Scotland, we've looked at the local market in Scotland and Edinburgh, which some of my colleagues in Estonia may not be aware, but it's a leading financial services and technology area within the UK, and does equip startups with good access to skills and a distinct investor ecosystem which works very well at the early stages, at the bootstrapping and pre-seed and seed stages. In fact, there are some Estonians who founded their startups in Scotland. I'm thinking of organizations like Kingdom Technology that were recently funded, a robotics startup run by Juan Kangro. It's also an environment where the Scottish government, in addition to the support that's been available through UK government from the furlough scheme and so on, there has been additional grant assistance for startups that found themselves in difficult cash flow situations. So it's been quite a supportive environment. And I found that distinct investor ecosystem, given some of the connections that are available, has worked quite well for us in that seed investment.
Can I ask you just one question? I mean, you've actually gone out and raised money. Has the pattern of investors changed as a result? Who is actually investing these days?
Well, in the local investor ecosystem, we found that the established local angel syndicates have continued to invest. Undoubtedly, there has been some impact on angels' own businesses, but some of those syndicates that have additional EIS funds and so on have found that their investment firepower has been increased by new government funding from the likes of the Scottish Investment Bank and the British Business Bank. So those kinds of organisations are continuing to invest, is what we've seen in the past couple of months.
Okay, well, let's turn to Tim. Tim's bio is absolutely fascinating. He set up a juice bar in Canary Wharf, which merged and morphed into Crush, which is a very successful, or at least it was a very successful retail operation. Then launched Flutter, which merged with Betfair, so he's in the gaming market. And in 2010, founded Augmentum Capital with money in particular from RIT, the Rothschild Group. And then that became, in 2018, the first publicly listed FinTech fund in the UK. I also note that he's an advisor, or has been an advisor, to Prince Harry on his digital strategy. That, I would think, is a really, really big ask these days. Tim, how do you see the market at the present time?
Thank you, Andrew, and good morning, everyone. Sorry I was a little late, just was finishing a board meeting. It's definitely a period of extraordinary intensity, and as an investor, I think, as Peter was alluding to, the focus from an investor point of view over the past couple of months has been predominantly shifted to portfolio rather than looking at new deal flow, albeit many investors are closing deals and continuing to explore. I think, just to give you a sense, typically we would see board meetings every 6 to 8 weeks across the portfolio. It would be once to twice a week at the current time. So yes, the week looks like a wave of meeting after meeting. So hope to jump off at 12:15 to get onto the next one. But yeah, it's been an extraordinary whirlwind, and I think rightly so as an investor. And I think venture investors often talk about being kind of hands-on, and having been backed by venture before I became an investor, that wasn't always the case. I think for us, we are a team of operators and entrepreneurs who've built billion-dollar businesses in the past. So we like to think that we know how to react in the bad times as well as the good times. And I think this has been extraordinarily challenging. I think what we have now, as we come to the end of May, are 2 full months of data of how portfolio companies across the spectrum are performing. And I think that's extraordinarily valuable and essential for incoming investors, because although there are numerous pot shots as to why would investors step away, why would investors change terms. The reality is you want to know what you are investing in, and if there's been a fundamental shift in the market, then you want to really understand what that data is telling you. And I think we are coming to the point where although there's nothing definitive, there's no question now that we're seeing kind of the first sense of stability. And I talk very much from a FinTech point of view. That is my kind of bubble. So I can't kind of really talk outside of that. We are seeing deals get done in the market. There's no question. A lot of the deals that you would have seen inked to date in the past couple of months, the majority of those would have been kicked off prior to March, to be perfectly honest. So these are deals that are getting closed. And so the big question is, what are the deals? What are the investments? What are the companies looking for capital in the midst of kind of the COVID crisis? And are these deals getting done? And if they are getting done, what is the new normal in terms of the terms? And I think we've certainly not seen that flow through. It's our sense that the majority of companies had runway, even those that were short of runway. And so, although you might have expected to have seen more distress in the tech sector, there's been incredible, amount of resilience, because we're far better placed to deal with this, scenario than those outside of it. But also, clearly, there are those companies, that in some cases are running out of runway, and I think you're going to start to see that in Q3 and Q4, where you will see, inevitably M&A activity. You'll see consolidation. You'll clearly see funding rounds, and you'll see funding rounds across a whole raft of different conditions. You'll see some at probably weaker terms than you would have expected, others at perhaps the same terms, and in some cases those businesses thriving in an environment at favorable terms to the company. But there's no question that valuations in the sector were starting to moderate long before COVID hit. And this has just been an accelerant for that as well. And we'll start to see that flow through, no doubt.
And do you see real value there now with some of the valuations coming off? Is this something that you see as a general buying opportunity?
I don't think we're seeing value yet flow through. I think we still want to invest in strong fundamentals. Clearly, there were a number of businesses that we're looking at. We've built relationships over the past few years, and arguably the fundamentals are there, but perhaps the pricing was too aggressive from our perspective, and so we'll continue to look at that. You're also seeing rounds that were closed a year ago, where I think companies are being quite prudent and saying, if we could extend our runway by a further 6 to 12 months and extend that round at those same terms that we agreed 12 months ago, therein lies an opportunity. Whereas an incoming investor, you're going with your eyes open. The price is being maintained, so existing investors aren't taking pain, and you can come into a company that that you feel has strong momentum despite the backdrop of COVID as well. So yeah, I think we are always looking for strong underlying businesses with a path to profitability. Clearly, we're backing fast growth businesses. A lot of them are still burning cash. I would say the rule to date has largely been CEOs, CFOs have been looking at their runway, seeing where they can reduce discretionary expenditure. In some cases, that's obviously above the line and below the line marketing. That's partly reducing headcount or slowing down hiring, and expansion plans as well. So I think the days of unlimited capital at headline valuations are certainly over for the foreseeable future. But of course, there are going to be outliers in that scenario as well.
Let me ask Richard and Peter that the same real question: lengthening the runway, leading to consolidation, M&A activity in the sector picking up. This idea of lengthening the runway, cutting your costs, and staying grounded for a little bit longer before takeoff. These analogies are always tricky, but very seductive. Richard, is that what you see?
Yeah, absolutely. And I think one of the key things about thinking about the fast growth early stage businesses is a lot of the time they are EBITDA negative. So that runway and burn rate is key. The process of raising funding is not an overnight process anyway in the best of times. So we always talk to our clients about having minimum of 6 to 9 months runway when you start going into a process. And then at the moment, as Tim mentioned, some processes are going to take a little bit longer, just by the nature of making sure that the current circumstances are right, making sure that you actually really understand the business and that the fundamentals are there, because good businesses in good times and bad times, the fundamentals have got to be there across both. And so a lot of businesses, as mentioned, that has been the key in terms of extending the runway and making sure they come out of this current situation, which is, I know the word has been overused to the max, but unprecedented, as we all sit in our homes. It's that coming out of the current situation stronger, or at least as strong as they were before, is the key. And so that runway element is,
consolidation in the industry, are you, particularly in the fintech industry, I guess, are you looking for that?
We're not. A few of the businesses we've been talking to have talked about that. I think the expectation about 2-3 months ago in early March was that this would happen and consolidation would happen. M&A opportunities would occur with really depressed valuations, a lot more than has actually happened. As I mentioned before, it may have been the output of the government reaction to the current situation, with the furlough scheme allowing businesses to cut their burn rate, whether through the government schemes or otherwise, as well as other mechanisms, and obviously the recent release of things like the Future Fund as well to increase the fundraise.
Well, let me ask Peter that, because Peter said that Wallet has made use of the furlough scheme. I mean, you have, as it were, extended your runway, have you not?
Yes. So I think taking a step back from that, the world has changed, and I think for an organisation going into this crisis, if they haven't revised their view of their revenues and their target markets, and showing that how that business plan has changed in the light of a crisis, which will have repercussions that certainly will last at least a year from now, and perhaps leaves a world that's quite fundamentally changed afterwards. So if that hasn't been carried out, then really those business plans and revenue plans perhaps no longer stack up. So yes, we've certainly had cause to think about how we needed to manage our runway. We made brief use of the furlough scheme when we saw the immediate response to lockdown within the UK, and then we're able to kind of regroup and replan around a slightly more extended fundraising cycle for us. And one thing I think we've thought about since is that the runway needs to be longer. I think most advice we've had from investors that we've talked to is that you need to be thinking about 12 or a 24-month runway when you're raising funds, because anybody who says that they really understand how this crisis is going to impact the global economy is probably lying, because nobody has a crystal ball just yet. And I think it is going to take some months before that becomes absolutely clear. So the implications for us were to regroup, take advantage of some of the schemes to extend our runway, and then make sure that we had a plan in fundraising that gives us all of the contingency that we need to see through all of the changes as we take an extended period of a year or more to reach a new normal.
I mean, I think that's really important, a year, 18 months to reach the new normal. Can I ask, Tim, you're involved to some extent with the Future Fund, the government's new initiative in this area, the UK government's new initiative in this area. Is this actually going to make a difference? Is this going to allow companies to extend their runway, as it were, and survive into the new normal?
I think it's going to be a significant fillip to our ecosystem. It's a pool of capital that's currently earmarked to be 250 million from government matched from the investor community, private investors as well as venture community, 500 million. it looks on day one there were applications of north of $500 million, so already 2x on day one. I think the government was nervous that it wouldn't have the impact that they hoped. It's certainly our hope and expectation that this will be increased. The key question is, does that money go to the right businesses? What we want to ensure is that it does exactly what the objective is, which is to back our very best businesses that, through no fault of their own, have been caught short during this crisis and require that runway in order to kind of give them the opportunity to succeed. What we don't want to do is create a generation of businesses that are going to become zombie companies, are going to use this capital to stretch it out. If you look at the rapidity of how they've launched this scheme, for a government, it's quite extraordinary. Normally this would take 18 months to pull together. And so there has been huge amounts of kind of input, lobbying from a variety of vested interests to ensure that the scheme meets their requirements. It has not satisfied everybody. And there's been quite a lot of, I guess, negative sentiment about the lack of EIS applicability. I think the challenge here is, from what we're aware, and I'm no expert in state aid, is that, you know, it makes it very difficult for EIS to be included. But I certainly get the impression that the desire is for kind of government to find a way for EIS in some way to.
Let me ask Richard to come in on that. I mean, EIS involvement, it seems to me to be fairly important, perhaps even crucial. What's your view?
Yeah, absolutely, Andrew. So EIS is obviously a great boon to the UK investment community, and allows the earliest stage businesses, it sounds like Peter's, to get that early stage investment to be able to scale to the stage where they're able to raise the institutional funding, like that Tim offers, mentioning both panelists. What we've seen, as Tim mentioned, in terms of the future fund, it is difficult, and he's right in terms of the state aid. And particularly, as I think until the end of the year, it still falls under, any changes would fall under the EU legislation as well. Putting that through with the speed and rapidity that would be needed to actually support the companies doesn't sound like it would be possible.
Can I just cut in here? There were stories in today's FT or that we have been, as it were, too respectful of EU legislation, given that we're coming out of the European Union and indeed are already out of it. We are more respectful of European legislation at the moment than most of the EU member states. Is that something that you would think as fair criticism?
Probably not something that's within within my scope to really comment on. So I'll let the people who are best judged and best placed to comment on the details of that.
Peter, EIS involvement, is that important for you?
I think it has been in the past, and in our current investment round, some of those funds come from EIS funds. So yes, it's certainly important. I think in I'm not completely au fait with the recent government scheme, but it does, based on a cursory glance at it, it did seem to have some terms which were less attractive to founders, and there were some other reasons why it might not be quite so attractive. Others might have more information on that than me, but yes, certainly EIS and support is very important. Not tripping over state aid rules is something which I think certainly in the Scottish government scenario, there's been some grant aid that's been made available under emergency state aid frameworks. So it does seem to be that there's some movement away from sticking to the I guess the letter of the EC rules.
I think what we've not been able to do is to make this suitable to everybody. But if you just look at the numbers, and these are the applications, so we've yet to see the flow of money, to have £500 million of applications in a day, and arguably this could be as big as £1 billion, to have that injected into our tech ecosystem is extraordinarily valuable. And what it's doing is it's unlocking that private capital as well, because pound for pound this is being matched. And I think investors are sitting on capital. We have seen private equity and venture capital.
Where is the private money coming from? That'd be really interesting to know, the matching funds.
Well, we'll find out in due course. None of that is disclosed, and none of it has closed yet. I suspect the vast majority will come from venture capital. But in parallel, I know a number of companies that have private investors that, although this doesn't qualify for EIS, they want to continue to support the company and believe it's fundamentally a good investment. And if that can unlock pound for pound, government support. And remember, this isn't a grant. This is a loan that converts likely into equity as well. So you're going in pari passu with government. So certainly we are looking at it for both our portfolio and potential other investments that we're not yet in, and we'll look at it on its own merits. We want to deliver a return for our investors, so we absolutely need to make sure it stacks up. And so I think ultimately, this should give a compelling return to the taxpayer.
It reminds me of the good old days of Bog-off, buy one, get one free. And government-involved matching is always very attractive. We are open to questions. They will apparently pop up on my screen, and can I encourage anybody who's watching to send in a question, and I will ask our panel that particular question. But there's such a lot going on. I mean, I think that, let me ask you about the government's overall policy in Scotland. I mean, Peter, you suggested that the Scottish government was taking initiatives which were not, which were additional to those in the UK, more generally. So tell us about what is happening in Scotland, and is that putting Edinburgh in a particularly advantageous position?
So I think that there have been several schemes. The particular one which I mentioned was around special support for organisations which were pivotal to the economy. So it was called the Pivotal Enterprise Resilience Fund. I'm afraid I don't know the overall size of the fund, but it was prioritised for innovative and tech companies who were suppliers into government and in the health service, and who had a disproportionate impact on the local economy. So that scheme was opened, I think, about 3 weeks ago, and received many applications. And I know that a good proportion of the fund has gone into companies in the tech startup ecosystem, and it was made available as a grant rather than a loan, and has really plugged the COVID gap for many of the early stage tech startups who were negatively impacted by the immediate aftermath of lockdown.
Can I ask Richard? I mean, PwC has a sort of global footprint. How do we stack up in terms of our aid for or support for the tech startup sector during this time of crisis relative to other European or indeed our transatlantic cousins?
I can't comment too much on that because I haven't looked into the details, if I'm honest, about lots of the other countries. But from what I've seen, the pace and the support which has been given is on par or better than many other countries. And I think we're seeing that just through the number of high-profile administrations or lack thereof, to be perfectly honest, in comparison to any previous disruptions to economic activity, before calling it a recession. And as Tim mentioned, what's in place, there was never going to be a one-size-fits-all solution. I think that was going to be impossible, particularly with the pace that the government are putting anything forward. And therefore, there's always going to be a few pitfalls in any of their solutions. But I think compared to other countries, what they put forward and allow businesses to cope with has been fairly impressive.
Well, let me ask Tim, because we've just had a question in from one of the viewers. Are you looking at companies to invest primarily in the UK, or are you looking more broadly at investment opportunities in Europe, particularly in Estonia, I guess?
Well, we'll invest. Our mandate is to invest across Europe. We have an investment in an Estonian company by the name of Monese, which is one of the digital challenger banks. So obviously we follow the Estonian FinTech market very closely. We've seen some extraordinarily high-profile and successful businesses coming out of there, and we continue to follow that market. We invest Series A and later, so we're not actively deploying capital at seed, but we certainly track a significant number of seed investments. I'd say in the last couple of months, the focus has been almost predominantly on the portfolio, but as we start to get to the new normal, we'll certainly be looking to become more active again. I think from our point of view, we've always talked about getting to the end of June, making sure that we have clarity on the portfolio, their capital requirements, because you want to make sure that you've got sufficient capital to continue to support your portfolio in the new environment, and then look to start becoming more active in the market as well. But yeah, we believe there's significant fintech opportunity across Europe. We're still extraordinarily early in this journey as well. If you look at all the stats when it comes to financial services, the incumbents in terms of kind of global revenue pools, they still own north of 90%, which when you transpose across other industries is much higher. So we've still got a long way to go. The opportunity is still very much ahead, albeit
But let me ask you. I mean, at the present time, is the UK government getting it right in terms of the aid that it is, support that it is putting into the fintech sector relative to France? I sort of get the impression that the French government is immensely active in this area, and we are actually lagging behind. And I'm not sure whether that's a correct impression. But from your portfolio experience, how do you feel that we're stacking up in terms of support?
Well, I think the French are playing catch up, to be perfectly honest. In terms of fintech in Europe, the UK accounts for more than half of all total investment. So, we are in the UK very much the European hub. We're arguably the global hub as well. We're funding more companies than any other country. So, I think if you look at the support over the past 5 or 6 years, and there's plenty of things we can criticize our government about at the moment, but in terms of support from the regulator, from the central bank, and from Treasury, all three have worked collaboratively in recent years to kind of build the ecosystem that has been developed. And I think if you spend time in France and Germany in particular engaging with the regulator, in Italy and Spain, it's a very different conversation you're having there with the forward-looking approach. So, I think France structurally has significant challenges. Clearly, there are some big fintech businesses starting to be built, but they are a long way behind us, and the question that they and other countries are playing catch up.
So if you are, when it comes to capital markets as well, if you're raising capital, London, you anticipate will remain the #1 place to raise capital in the fintech sector?
I think if you're a fintech entrepreneur, London still remains, the most attractive country, city, I should say, and it's not just London; it's the UK. I mean, there's a great heart in Edinburgh that we're building as well, and in Belfast. So I think yes, we've been very London-centric, but I think we recognise that we're trying to, we want to kind of export that talent, because there is significant tech and fintech talent beyond. Of course, it very much depends on the business that you are building, but the centre of gravity remains here. The capital pool remains here, but markets such as Germany and France clearly are developing, and one can't be complacent. So yes, we're ahead of the curve, but we can't rest on our laurels.
The fintech, you're ahead of the curve. If it's automobile production, probably Paris is the place to go to get your money these days. Richard, are you optimistic about the UK, and particularly in London and Edinburgh, as maintaining their position as providers of capital to the fintech sector, and indeed to technology more generally? in a post-COVID world, or in the COVID world and in the post-COVID world? Richard?
Yeah, absolutely. And I think you always have to be optimistic either way. But I would say almost stepping back to prior to COVID, and something you mentioned around the SEIS and EIS schemes, which is something that, as I mentioned, we are ahead of the curve in terms of the way that we support businesses beyond the government support that's going on at the moment. So those will still be available for private money for the earlier stage companies to keep developing and innovating. And I think as long as that goes on and that support's there, because without the support for the earlier stage companies, we don't have those innovative, exciting companies coming through for people like Tim to invest in at the Series A and Series B stage. The other thing is that there is a halo effect that's a lot more kind of medium to long term than short term, of companies like Revolut and Monzo, among others, coming out of the UK ecosystem and being backed by UK angels and funds, and therefore others looking from outside looking in, seeing the great activity in the fintech space in the UK and across the whole of the UK. So that, I think, will remain beyond or into the new normal. So.
And Silicon Glen, Peter, how does that look?
Well, so far as I can see, I've been quite focused on my own affairs, but so far it seems to be continuing to be vibrant. There are new ideas coming out of the universities, and there's a possibly even more activity in the very early stages, in the immediate after, in the recovery from the COVID crisis, and some of the ideas that have come forward in addressing what the new normal will become. So I think that makes me fairly optimistic about the performance of Scotland as a region, and Edinburgh in particular.
What about American involvement? I mean, transatlantic money has always been very important in the private equity area, in venture capital more generally. Everybody is always saying, well, the UK is doing very well, but it isn't doing anything like as well as the US in this sector. Has the US sort of pulled its horns in? I mean, this whole idea of localization, of a retreat from globalization, is this starting to hit the venture capital sector and the tech sector in particular at all? I give you Tim's view.
Sorry, Andrew, I just lost the last 5 seconds on that as my signal
I
froze.
was just wondering if US investment, which has been particularly important in this sector globally, I guess, are the Americans retreating? Are the American PE and venture capital companies starting to look more at home and less abroad? Is there any sense of relocalization in this sector?
Well, we definitely had seen in the past, year in particular, increasing capital from US venture funds, in particular in the fintech space. I think because the center of gravity for fintech is not in the valley; tends to be on the East Coast, but also increasingly they are looking to London and beyond the UK and Europe. We were seeing more and more investors that hadn't been seen here for, if at all, or certainly in recent years. I think it's too early to tell whether they're retreating. I think, the challenge of not, meeting in person is one that, we have to adapt to. And I think, that is a challenge. Investors say they will invest on Zoom calls. But again, the proof will be in the pudding or in the data. So there is, and there has been continued interest in Europe from the US, because they recognize now that the old stereotype that we can't build, very big businesses is becoming a thing of the past. We are starting and have built some very material businesses, in particular in the fintech space. So, and as we said earlier, there is more capital, there is more dry powder in US private equity and venture capital than there has ever been before. So they've got to find a home for that capital. So inevitably they will be looking here, although we've seen in the past that they have bypassed Europe, but we think that is changing, and hopefully this will just be a short-term blip.
Right. Well, that's interesting. You say that in the past they bypassed Europe. They've bypassed Europe to look to East Asia.
They have, yeah.
Presumably, the Chinese market is, I would assume, going to be rather less friendly, rather less accessible than it was in the past. However, Singapore and Thailand and Taiwan may look more attractive. I don't know. How are you thinking on that? How does Asia look?
Yeah, I mean, I think from our side, we're so we're so UK focused and kind of beyond, but we end at Europe. So I think we've seen increasing interest from Asian investors looking to get exposure to Europe. Obviously, a weakness in the euro and the pound has made it attractive. Obviously, when you look outside of China, markets such as Singapore and Hong Kong in particular, although they are trying to build tech and fintech hubs there, we've not seen the breakthrough companies that have come out of there. So yeah, certainly from our point of view, there is interest from Asian investors inbound, and part of that interest is seeing whether European tech companies can then expand to Asia. China is a difficult market to navigate. I lived for 6 years in Hong Kong. I launched Betfair's international business, so I understand that market reasonably well. But you need to be very much on the ground there, and you need to be local, and that's a challenge.
Well, let me ask Richard the same question. I mean, what is your view of the wider global picture here?
Yeah, as you mentioned, Andrew, it's the Far East is an interesting place at the moment and may not be viewed as positively or attractively. Particularly for something Tim mentioned in terms of being able to be there and understand the different cultural differences and the ways of work. And I think one thing I've been hearing from a number of investors is that sometimes in good times, when looking at their thesis, they can stretch the thesis of investment a little bit to expand this and look at alternative opportunities that can loosely fit into that. When things get tougher, a lot of the time people go back to exactly what they know. And for example, for Augmentum, as an example, as a UK and European fintech, I wouldn't imagine that this is the perfect time to stretch outside the confines of where they're experts. And I think that's covering across a lot of the industry. So those who were interested in the Asian space previously will remain so. I wouldn't imagine people will be thinking, oh, brilliant, let's use this opportunity when there's so much uncertainty to take a few punts. I don't think that's really what we'll be seeing anytime soon.
Well, that brings up a question that we had just now about working patterns, and I noted that Tim also mentioned that. Will people actually sign off on deals that they have only done on Zoom? I find that I'm of a generation that's rather cynical about new technology and also rather ignorant about new technology, and I still want to see the whites of people's eyes. I still want to be able to share a coffee with them. I don't trust any of you on Zoom because you're probably wearing pajama bottoms, and I don't, you've just crawled out of bed. It still seems to me unlikely that people will put real large amounts of money on the table on the strength of Zoom calls. How do you feel about it, Peter? You're a technology geek, so presumably you feel that much as comfortable in the Zoom world as you do in a real world.
Yeah, in fact, my background was in exactly this technology, where I worked for Microsoft for a couple of decades around unified communications. So I'm optimistic on that. I think it's too early to say, and certainly the investment backdrop in the local ecosystem in Scotland is very much based on personal contact and so on. But I think if that's the case, that investments couldn't be completed if relationships had only been formed over Zoom or Teams or video technologies, then I think the same would apply to a lot of organizations that want to make B2B sales. So I think we have to believe that in the new normal, whatever it becomes, that we can't hop on a flight to the Far East to close a deal. We're going to have to do these things increasingly using the tools that are available, and taking advantage of our culture for making those connections over these tools as that expands over the next months and years.
And Tim, I mean, you share that enthusiasm, not enthusiasm, maybe it's a reluctant acceptance of a new situation going forward.
Yeah, I think that's right. I mean, we all have to adapt, and you're right, Andrew, that a lot of us are conditioned to want to see potential entrepreneurs in front of you, because I think a lot of ideas that you read are sound plausible and compelling, but ultimately it is up to the entrepreneurs to bring this opportunities to life. And as we often say, it's about the execution, not just the idea. And I think you really got to have that confidence. I think it's a little easier if you're investing later in the cycle, because you've got more data. You can rely on. But for those seed and pre-seed investments, it is a challenge. But I think we'll all be adaptable. And ultimately, there's no question that between now and at least the end of the year, travel is going to be reduced dramatically, and we're going to have to kind of rely on on platforms such as Zoom. But as I said, I think for a lot of us in the tech space, this isn't anything new. We've been using these platforms for years, but ultimately, I must say, I've never made an investment solely on having not met the individuals, and so that's something which I personally need to adapt to. But I would certainly say the younger members of our team seem far more comfortable at it.
It always reminds me of those early jokes about the internet, that on the internet nobody knows you're a dog. Can I just read you a question that has come in from Moni's being mentioned? As a fintech that provides its software and services on a B2B model, entering the UK market and or raising investments there has proved to be quite difficult. Particularly, it seems to be a dead circle situation on the most part. Many investors in the UK want to see the company's presence in the UK. Presence physically requires investment, and clients want to see local investor traction. How would the panel comment on this situation that many of the foreign B2B and B2C companies are facing when looking at the market? Is that something that you recognize in the specific example of Moni's?
Yeah, I mean, I guess Moni's is a B2C business, but has presence in Estonia, and ultimately the consumer market wasn't big enough and came here to the UK to kind of launch the proposition and has expanded across Europe. And I think it is a fair question. So if you are a B2B business operating out of Estonia, and you do have global, international, pan-European customers, then I think that is a distinct advantage than being solely focused on your core market. Ultimately, I think yes, VCs are sometimes guilty of following the crowd and looking to invest in packs, and perhaps wanting validation from another local investor. But there are plenty of examples where that isn't the case, and fundamentally, as we move into this environment where we can't necessarily meet entrepreneurs and companies in person, that perhaps could be an advantage for those B2B businesses that don't have a presence in a market such as the UK. So I recognise that it is harder. I think what is more important is to understand that the market that you're targeting has the scale, and that you have proven that you can sell outside of your core market rather than necessarily having an investor in your in that market as well. So,
okay, another question here, which is perhaps something that we slid over, and perhaps I can ask Richard just to explain it. It's presumably from one of our Estonian watchers. Describe furlough as it is very UK specific, and also briefly explain the EIS enterprise scheme. Could you possibly fill in the two holes that we may have left there, Richard.
Yeah, of course, and I'll take them. And apologies for the lack of transparency at the beginning, as they've been mentioned a number of times. I'll start in order. So furlough. So this is a government scheme that has been put into place by the UK government to support businesses of all sizes, but for permanent employees. And they have said that employees who are put on effectively for the business unpaid leave, so they're not allowed to work during the period of furlough, but the government will cover up to £2,500 per month, up to 80% of their salary across that period while they're not working. So that's just some government support for businesses who have obviously seen a downturn in their revenues, and instead of having a number of people laid off and made unemployed, the government are able to cover the majority of salary for the interim period before hopefully things go back to a new normal and the businesses pick back up and they're able to pick the salary back up. So that's been going since March, and I believe has been extended until October for the moment.
But the likelihood is that it will not cover 80%, it will cover 60%. Going forward. And one of the great problems is that, after all, people who have jobs rather than careers are not paying commuting fares, and 80% looks pretty damn good.
Yeah, very much so.
The EIS scheme.
Yes, so EIS and it's the Enterprise Investment Scheme, and there's a smaller one called the Small Enterprise Investment Scheme, which is SEIS. This is support for investment into early stage businesses. UK businesses with a UK permanent establishment or based in the UK. So UK investors, individuals, angels and high net worths can invest into these companies and effectively get a tax shield. So they'll get a 30 or 50% tax rebate on the amount that they invest. So 30% for EIS investments and 50% for SEIS, so investments. And the SEIS allowance per year for an individual, I believe, is up to £100,000, and then the EIS allowance is up to £2 million per individual. And the companies also can only take a certain amount of money in each of those brackets. But it does allow individuals to invest a little more freely than they may otherwise, because they know they're getting that rebate on their tax bill.
How important has that been to you, Peter, the EIS scheme?
So I think it has been important and continues to be important. We took advantage of it in a pre-seed round, and will be partly taking advantage of it in a coming seed round. So I think it's a great scheme for investors, which creates an engaged community of angel investors, and provides a way for even some of the larger institutions to fund SMEs and startups like us. So yeah, I think it's been very important. It's possibly a bit of a byproduct of the complex tax regime which we have in the UK, which our Estonian colleagues won't recognise, but it does work well for startups.
Any further thoughts on the EIS scheme, Tim?
No, I mean, it's it's been a huge success in the last 10, I'm not sure how many years, it's been in 10, 15 years. And it's, if I go back to when we started Betfair 20 plus years ago, and I look at where we are today, the catalyst of both private capital as well as venture capital has really kind of created this tech ecosystem, and we're in a very different world to what we were back 20 years ago. And I always understand that people want more incentives and greater stimulus, but ultimately I think we've built an extraordinarily powerful ecosystem here, and long may that continue.
Let me ask the final question to each of you, the three of you. Put yourself 18 months into the future. What does the UK's venture capital, FinTech ecosystem look like? What are going to be the changes that you would notice? What are the things that are likely to persist over time? First of all, Richard.
Well, hopefully you won't pick me up on any mistakes I make in 18 months' time, because I'm sure we won't be spot on. But I would largely think with fintechs, as mentioned earlier, I would largely expect that to remain kind of the jewel on the crown of the UK venture ecosystem. We have seen that it's not the easiest time at the moment, but I would expect things to pick back up in the next 12 months. The fact that new funds are being raised by individuals and also by new funds at the moment, albeit a smaller amount than expected, is positive, and so I would expect things to continue to progress over the next 18 months. Those that will be successful and will be raising and doing well in 18 months will be those that have those solid fundamentals, and I think a lot of investors will be going back to and B2B businesses are largely able to fundraise more easily because of the proof points, the product market fit, and the monetization you can get from that, rather than having lots of unpaid consumer users. So I would expect those with really strong fundamental unit economics to underpin the success within the next 18 months. But I would definitely expect the continued success of the fintech ecosystem in the UK. Peter.
Well, I don't have a better crystal ball than anyone else, so I think that it's sometimes futile to look so far in the future and think what the funding environment might be like then. But I'd like to hope that there would be, in the aftermath of this global crisis, there'd be perhaps an environment where investment was targeted at organizations with the right kind of ethical background and looking at an ethical recovery from the crisis. So that would be my hope, and I certainly, as a startup just about to complete a seed round of investment, I'm hoping that I won't be back to the markets anytime soon. Certainly not within that time frame.
The final word, Tim, is with you.
Thank you, Andrew. I mean, it's too hard at the current time to be too definitive. I think, clearly between now and the end of the year, we're going to see some kind of challenging fundraising conditions persist outside of the Future Fund. I think the quality will rise to the top. I think valuations will continue to moderate throughout 2021 as well. There will clearly be, capital will gravitate to those businesses that operate and grow effectively in a post-COVID environment, and it's you'll see a shift away perhaps from travel and leisure. Clearly, kind of digital as an industry will thrive, but even within that, people will gravitate to those businesses that are performing better, and in some cases at a far more accelerated rates than they were previously. So the UK, in my view, will continue to be the centre of the digital ecosystem in Europe. I think fintech will continue to thrive, but ultimately, we're going to have to batten down the hatches and focus hard over the next 6 months. But yeah, the long-term opportunity doesn't change.
Okay, well, can I thank Tim Levene, Richard Abrams, and Peter Ferry? Can I thank Enterprise Estonia? And I'll hand you back to Enterprise Estonia's Heikki. Heikki, I hand back to you.
Thank you very much, and once more, just one comment from me. Of course, thank you for joining, and I will encourage you to work with the companies. I will bring the EIS and the furlough scheme comparison in Estonia. Unfortunately, we don't have such generous funding tax available for companies. So therefore, companies will have to come out through a lot more limited furloughs if you compare it with the UK scheme. yeah, I will encourage our scheme was only limited to 2 months. So the companies really, really had to adapt super hard, had to make very, very difficult decisions. But in that sense, I would, for all the venture capital and for all the other agencies involved, I would encourage you to work with the same companies and also encourage the same companies to approach the relevant partners in the UK to fund such models. And also, Peter, thank you for your message. You're saying you're very, very welcome to have that dialogue with Estonian companies, and I'm sure same extends to the rest of the panelists.
Thank you all. Thank you for watching, and I hope we see you again soon.
Thank you.
Thank you.
Everyone.
Thank you.